Let's get an idea of how big all this trade war stuff is. Joining us now live at the desk, Michael McCarthy from CMC Markets. Welcome. What do you make of this? Are we all really worried about what happens tomorrow morning?
Well, we've certainly got more concern than we did on Friday morning, let's put it that way. But I don't think shareholders and investors generally should be panicking at this stage. Remember that we'd had a good week for markets generally. Share markets in Europe and the US had risen over the week, and we had a major market event in the speech from Jerome Powell. And so it's not unusual to see markets take back some gains ahead of a potential...
Do you think the market will be happy with what Jerome Powell has said?
Overall, certainly, and the way US markets reacted when he was speaking, it's pretty clear they were happy with it. But remember, European markets had fallen 1% before this had happened, so we should have taken 1% off the US market anyway. The markets rose after Mr Powell's speech. They seemed to ignore entirely the announcement from China that it was increasing tariffs, and it was only when the tweet storm erupted and the spectre of the extraordinary powers was raised that we really saw a market.
Yeah, and what about Jerome Powell and President Trump? Trump actually saying that he's as bad as the head of the Chinese
called them, which is the bigger enemy. What an extraordinary development that you would name the president of a major power and the head of your own Federal Reserve as an enemy. I thought that was just amazing. But Jerome Powell operates by a different set of rules. He is a central banker's central banker, and so he couldn't say what the markets really wanted to hear, and that was he would not give in to pressure from politicians when it comes to monetary policy.
Michael, I wanted to ask you about the domestic scene. It's been a bit overshadowed this reporting season by what's going on globally in the share market and trade war, etc. But really, that has probably overshadowed what was a pretty good reporting season, don't you think?
Well, certainly better than expected, Leo. And I think one of the big surprises, with 152 out of the top 200 having reported, is sales growth averaged across those 152 companies of about 8%. That's quite positive and better news than we're expecting. Even on the earnings front, it's pretty clear that we're getting better than expected results. The gains at the moment are just below flat, whereas markets were expecting a fall of 2 to 3%. In earnings. So the 1.4% average bounce we've seen in share prices from those that have reported illustrates shareholders were expecting worse than what we've seen so far.
Take you through a couple of them specifically, Michael. Lendlease I thought was really interesting. Steve McCann, because he's got that huge engineering business to deal with. But here's him talking about the prospects.
Well, the market loved it, didn't they? Share price up $3 after these announcements.
Well, I'll interrupt you. Let's have a listen to him now.
Very pleasing reaction, obviously. I think we have highlighted to the market the growth in our development pipeline around urbanisation in gateway cities. That's been well received, as has, I think, the strength of our balance sheet. We're in a strong position from a liquidity perspective, and there's been a good reaction to that.
So, Michael, that's all about looking forward, yeah?
Oh, absolutely. Clearing the decks, getting the engineering business off the books is one of the keys to the outlook for Lendlease and for its shareholders. And I think that positive announcement around due diligence was pleasing. We also saw good news around the pipeline, increasing to almost $100 billion. That's good news. And, of course, one of the key questions for Lendlease is what happens once the infrastructure build that's been going on falls off. That increase in the pipeline speaks directly to that concern.
What about A2 milk? Everyone loves A2 milk, and here's Jane Herdlicker, who I spoke to from New Zealand, talking about how fabulous the company is.
Well, this has been a really important year for us. We've obviously delivered an excellent result, record financial performance, market share results across the board are really impressive. And we've also been investing significantly behind our brand, building organizational capability and capacity to really ensure we're building against our potential in China and the US in particular.
Now, Michael, the market tanked.
A2 milk was smashed in trading. One of the problems was the headline growth expectation was around 50%, so it's a slight miss. It must be hard for CEOs when they deliver 47% growth in profitability and see their share price trash.
Do you think there's nervousness around A2 with China as well, given the importance of the market for them?
Talking to a couple of analysts this week, the major concern for them was the contraction in margin. It fell from 31% to about 28.5%, and the forecast suggests it's going to be closer to that 28% level. That changes valuations across the board. Now, there is certainly a good argument this is good news for A2 milk. They've got their eyes on the longer term, and they're investing in their business. But the hit to margins could be one of the key reasons why we saw such share price pressure.
All right, Michael, let me ask you about Qantas, because they obviously were hit by rising costs, particularly on the fuel front. We'll just hear from Alan Joyce now.
I mean, these were really good results given those headwinds. We had 770 million of headwinds when you take oil and the currency, the US dollar being strong against the Aussie dollar. Our fuel price went up by around 600 million. And we also had a non-cash item, which was 90 million because of bond rates. And the market, we missed our consensus because of that one item, which was very hard to forecast. If we hadn't had that, we would have been above consensus. And I think people are saying how robust Qantas is. The last 2 years, oil prices have gone up by over 900 million. Our profitability is still at these amazingly high levels.
So, Michael, what should shareholders make of this? It seemed to me he was battening down the hatches a little bit.
Absolutely. Well, what comes out of this clearly is Qantas is a very good operator, and Alan Joyce has done a very good job of optimising the opportunities available to the business. However, a lot of the optimism we're hearing about Qantas is based on things that are outside Qantas's control. That is less competition and lower oil prices, and neither of those, in my view, is a given. The share price reaction since the results has been fascinating. On every one of the 3 trading sessions we've seen since the result, the share price has opened up, zoomed above $6 and failed again. And that tells me there's substantial selling in the market. So despite a lot of positive commentary around this Qantas result, and it is a very good operating result, I suspect the share price is telling us there could be pressure to come.
Yeah, low Aussie dollar probably not helping as well. But look, BHP, broadly speaking, was pretty well accepted result.
In line, I think, is the most common phrase I saw around the result, and that's exactly what it was. Interesting to note that net debt here is now the same as 1 year's profit. So they are in an extraordinarily low gearing situation. That gives them plenty of room to move. They did announce $8 billion in capex for next year. I think that might have taken the market a little by surprise. And overall, the operating earnings were slightly worse than analysts were expecting. But I'd say that the market hasn't really reacted to this result. It was very much expected. And the reason we've seen such share price pressure on BHP has to do with falls in the underlying commodities.
So, Michael, when you're looking at sort of capital allocation, how companies are dealing directly with their investors at the moment, this reporting season, are you seeing any trends?
There's a lot of caution, let's face it. A number of companies have moved away from even issuing any guidance. And that tells us there's a lot of uncertainty about the environment. And given what we saw on Friday night, I think that's probably reasonable for management teams to be a bit cautious about the outlook. One of the keys, I think, has been, and one of the key surprises, has been better than expected consumer behaviour. And the sales that we saw at Coles there, 3% up, the extraordinary result from JB Hi-Fi, which confounded the short sellers and saw its share price hit a record high, points to one of the key themes this year of being a better than expected consumer performance.
Well, an unpredictable area as ever is media. We had 2 big media companies in Australia reporting this week with 2 very different types of result, at 7 and 9.
And 2 very different share market reactions. And I think it speaks to what is the emerging media model. The very multi-channelled, cross-leveraged use of content appears to be working for Nine. And I suspect that that will provide guidance to other media companies as how to make way in what is a very disrupted media landscape.